All right, good morning, everybody. Welcome to the Friday edition of the Power E Mini Group Training. I'm Bill, and I have Jeffrey on the Skype, and we're going to go ahead and get started today. How you doing this morning, Jeffrey?
Doing great, Bill.
Okay, the sound looks pretty good here, and so let's take it away.
All right, folks, in today's group meeting, what we're going to do is review the scalp targets that you're going to want to focus on and use with the new micro trader that was introduced a little over a week ago. And so we're going to talk about each symbol, talk about the targets, and talk about some related stuff having to do with targeting and stops. Let's go to that next slide there, Bill.
Okay?
All right, so we are on the 4.6.1 version of the software, which has the new micro scalper, which is the timed alerts that come out now on a 20-minute cycle throughout the session. This was recently introduced, and we've done several training videos on this, the particulars, how it works. So we're not going to get into all that today, but what we're going to focus on is we're going to focus on the targets that you want to look for in the different symbols. Now, the big thing with the new micro scalper is that we get timed alerts on a 20, as I mentioned, we get timed alerts on a 20-minute cycle. And the way this works is, notice down in the white box there, you've got the range high and the range low. Those are or I should say, that reflects the dynamic trigger range that's generated for that time slot. Okay, so you're going to want to focus on those two price levels. And if you are not using the Ninja platform, you basically just maintain two horizontal lines on your chart. And when the new alert comes out, you just drag your two lines to those price levels. Whichever way price breaks, that is going to be the way that you want to play your scalp trades. Now, the alert software will go ahead and give you little alerts that we are breaking one way or the other. You can see the little green dot and the green arrow. So when the price starts to touch and move past one of the ranges, you're going to get those alerts, and that's going to clue you into, the correct direction to attempt to trade. But you're going to see it visually on your chart as well. If you're using one of the Ninja 7 or 8 on-chart indicators that we include at no extra charge with the service, then that's automatically plotted on your chart for you. And as we've talked about in the previous trainings, the preferred chart setting now is a 20-second bar chart. I'm sorry, 20-second candlestick chart. So we're going to go ahead and talk about that more later. But let's go ahead and get into each symbol here and talk about the targets and the stops. So let's go to that next slide there, Bill.
Okay.
Okay, so here are the 6 symbols that are currently running through our system. And again, we're talking about the micro trader algo. All right, this is not to be confused with the momentum breakout, the power target system. They have their own logic, their own targets and stops and things. So that's a different animal. These are to be used with the new micro trader. And so let's talk about these. Now, each one of these symbols trades a little bit differently as far as the way they break it down. Let's talk about the ES to start with. The ES trades in points, but the smallest increment is a tick, so that's a quarter point. So what we're going to be doing, all these targets I'm giving you here, well, the ES and the NQ, you can see they're represented as points, and then the other 3 are going to be represented as ticks. And a tick is the smallest increment that the price can move. All right. So The ES has 4 ticks per point. The NQ has 4 ticks per point. The YM has no ticks. It's just points, but it's the smallest increment that it can move, so it's also a tick. The CL moves in pennies. So each 1 cent move is a tick, right? And then the 6E, that's kind of a strange animal, but again, it moves in ticks. They do this kind of a wacky equation with the dollar versus the euro, which I'm not going to get into it because it's uh, kind of a little complicated, but it doesn't matter because again, these numbers are going to just represent the ticks, the smallest increment of movement. Okay, so let's go through these one by one. The ES, the 3 targets, and the way these are broken down, folks, is the first 2 targets are high frequency scalp targets. All right, these are I arrived at all of these targets after extensive back testing and measurements and of the calibrations of the normal price movement we get out of these symbols. So there's nothing magic about these numbers. These are just numbers that get hit with the highest frequency. All right. And so if you're going to be trading, you might as well shoot to take your profits at these levels. Now, one thing I'm going to mention before we go further is that nothing is perfect or nothing is set in stone in the markets. So we can have some variations on these numbers, which I'll talk about. We deal with approximations in the market, right? So in other words, the market might get halfway to one of these targets and stop, or it might go 2 times past one of these targets. So, but again, high frequency uh, fills at these targets is what we're looking for. So the ES moves in 2-point moves, and then it moves in 4-point moves. And then if we're going to make another leg past that, we can go out to the 8-point level. Right. So if you were going to do a trade, let's say with 3 contracts, 4 contracts, whatever, and want to string out your exits, this would be the preferred way to do it. Now, I'm going to talk about, when you first get started, you want to keep it real simple and, be one in and one out type of a trader. And I'll explain that as we go. But these would be your targets that you could go for. The NQ, 3 points, 5 points, and 10 points. All right. And then the initial stop of 4 points. Your YM. Now, again, it doesn't trade in ticks or quarter points. It just trades in points, but those are ticks. So we're looking for a 10-point move, a 20-point move, and a 40-point move. All right. One of my systems today caught 3 20-point moves in the YM today live. So it's very doable. And today's not the, most rip-roaring day we've had. It's the market's been going up, but okay, the CL, your high frequency targets are going to be 10 cents, 20 cents, and a bigger move, 40 cents. And then finally with the 6E, 8 ticks, 15 ticks, and then you go out to 30 ticks, right, with your stop losses there. All right, so let's talk about a couple other things while we're on this one sheet page here. Obviously, again, now, if your 2-point target, okay, that, again, if you go by ticks, that breaks down to 8 ticks then, right? It's the quarter point, so it's 4 ticks per point. You're going for an 8-tick target, but we measure in points, so it's 2 points. The initial stop is 2 points. Now I'm going to show you something here. Don't fret too much about these stops. Like, don't try to overanalyze it and say, well, why is, like the NQ, why is my first target 3 and then, my stop is 4? That seems too big. Don't worry about that because I'm going to show you why it doesn't matter. these are your initial stops. So if you're going to set up like just a basic ATM that gets you in, sets a target or two, and then plops a stop in, these are where you want to place your stops. Okay, the same with the YM. You can see it's your first target would be like 10, but the stop is minus 20. But I'm going to talk about that in a minute. All right. Now, let's just talk about a couple scenarios and we'll move on. If you are trading one entry in and one exit, right, which I recommend you do as a beginner, and all beginners should start on the micros, right? With the CL and 6E, I think the CL's got a micro, but I don't know that it works that great, and they don't do it by penny, they do it by quarter point or something. So the micro for the CL probably is not going to cut it. But the ES, the NQ, and the YM now have micros 1/10. They're beautiful. They're great training vehicles to come in, and you won't lose your shirt. Right? That's always been the big hindrance. The leverage in the futures market kills new traders because they come in and they simply don't have the risk capital to get through the learning curve because the leverage is too great. Now with the micros, and this is exactly why they did it, so people would stick around longer and be able to get through the learning curve and not drop out. The micros give you a chance to go in and trade, methodically, following a regimen and stick with the plan, and the risk is lower and it gets you off the runway, and then you can gradually, uh, move into the regular size contracts. Okay, so let's just take an example here. Let's say that uh, we were going to do a trade with, one in and one out, right? So the lowest risk way to start now is with the micros, just one contract. All right, you can trade to your heart's content day after day. The risk is low. You'll be able to stay in the game, get through the learning curve. Let's say that you're going to trade one in and one out, and we'll just take the example with the ES. Let's say you come in and your first trade of the day, you hit a 2-point target. Boom, scalp, you're out. The market appears like there's some energy, like maybe we're moving above and off the 5-minute range, right? We're moving to the upside, kind of like today. And your next trade you get in, you can go ahead and extend your target out to 4 points, right? Go ahead. You already got 2 points under your belt, and now you can extend it out to 4 points. Now, I'm going to show you a little trick as we go that, let's say it gets to 3 points and then backs off. It's not going to turn into a 2-point loser, right? Because you'll go ahead and ratchet your stop to around break even. But the point is you have a little leeway. You can extend things out based on the energy in the market. So let's say it's a hot day and you have a trade or two, maybe you took and they hit their targets, and you can sense there's a lot of energy in the market, and you get to break even on a trade, can't lose. Maybe you're past the 2-point level, and maybe you're like 3 points past your entry, and you go, you know what? I'm going to let this sucker run because I can't lose. Worst case scenario, I'll go ahead and maybe protect a point. If I see it come back, I'll go ahead and knock out at a point, at least grab a point. But I'm going to let that run for 8 points. So you can stick a limit order out there at your target 8 points out, right? Because once the market gets running, it can, go leaps and bounds. So this is a way you can kind of discretionarily move your targets around and extend them out based on the energy in the markets. Now, if you can sense that it's just really a crappy, slow day, then you go for a couple of just the first targets and call it a day, right? Okay, let's go ahead and go to that next slide then, Bill.
Okay.
Okay, remember I said, you know, don't fret too much about the initial stops that are recommended. Just set your ATMs up to put those stops out at those areas. Those are hard physical stops so that if anything happens, like you lose power, you faint, whatever, somebody breaks into your house, you've got to stop in, right? If the market goes haywire, you're going to get taken out without a big catastrophic loss. So, however, one of the new fangled things that we got going now with the new micro trader is we've really refined the calibrations on everything, right? So convince yourself, folks, that this new micro trader is the way to go, because not only did we zone in on the time frame, not only do we have tightened down dynamic trigger ranges, but we even tightened down the methodology that we play off of, right? So we got this like razor thin uh, these razor thin micro setups to work off of. So here's the point. Have your ATMs just set the initial wide stop, but with the new methodology that we're using to trade off the 20-second micro setups, remember, we're going to be protecting like the 2 to 3 bar range that we take the entry off that's past the dynamic trigger range barrier. So what that means is our full stops, we're never going to want to let our full stops get hit anyway. They're just in there for to protect against catastrophic loss. We want to keep them out there and keep them out of the way, so we've got the wiggle room. But what you're going to be doing is you're going to be protecting those little 2 and 3 bar 20-second ranges. Now, some folks think that, oh, 20 seconds, that's just way too fast. And, here's why it's not. Because the dynamic trigger range is doing all the legwork to get us to the setup zone, right? So it already on a larger macro scale knows where we should be trading from, in what direction. What we're doing is we're fine tuning our entries, and we're also fine tuning our little protection levels. And so if you think about it, like, previously we used like a 1 minute bar, and all we're doing is we're breaking the 1 minute bar up into three 20-second bars. So we're kind of getting to see what's inside a 1 minute bar, right? And we're getting to see the transition from like one minute bar to the next. So we've kind of just zeroed in a little bit deeper uh, on the price action. And remember, all this stuff, the way I designed it, it's calibrated to work off these levels the correct way. Okay, so don't be afraid of a 20-second chart. Obviously, if you were just left on your own to try to figure out like where should I take an entry on a 20-second chart, yeah, that could be tough going, because a 20-second chart can whip around, and it would be difficult to make heads or tails of which way to play, that type of thing. But again, the dynamic trigger range gets us right to where we want to look for the hot spots, and then we're fine tuning our entries and our protection levels with the 2 to 3 bar trick. Now, what that means then is that if you do this right, that your stops, your wide stops, are most of the time never going to get hit. You will probably only lose half or less than it would be to your full stop. Okay, if you're just protecting like a 2 bar range. Now, the reason we don't want to use a hard physical stop right there is because we want the wiggle room, because sometimes you'll see little price spikes. They last a half a second, boom, and they would have went down. Maybe they go right to the level you had your stop, or one tick past or whatever, but then they immediately go right back to where they were, right? So they just jam it down there like in a half second, split second. And then, so if you had a physical stop there, you'd be knocked out with a loss. Whereas using it more as a mental stop, and basically making the decision to close out, hitting the close button or the flatten button, right, instead of having your physical stop there, will keep you in a lot of trades. Now, once in a while you blink, you might get a trade where it might pop down and it's already running towards your initial wide stop, and then you just got to get out with as best you can. But more often than not, you're going to see that there'll be times where the price spikes down to that little protection level and then goes right back up to where it was and goes on in your favor. All right, so that's why I recommend you keep your initial wide stop at the wide level and then just use a mental stop and just draw a horizontal line on your charts, and you can watch the price action, right? Our ideal goal when we get into a trade is that the trade moves as quickly as possible in our favor and as quickly as possible away from our stop. That's our goal. That's what we're, uh, uh, attempting to achieve now with all these new refinements to the micro trader, getting down to these levels that we can get trades to move in our favor much more quickly. And you're going to see now that what happens is that we end up with some trades that are 5 to 1 reward to risk, 10 to 1 reward to risk, really good ratios because of this new methodology. It also can keep you in the game longer, because if you're taking stops on half of the initial wide position, then that allows you to take more attempts, right? And you're eventually going to catch something. All right, so let's go ahead and go to the next slide there, Bill.
Okay.
All right, so let's just take a look at a few examples here of the new MicroTrader. We get 20-minute intervals. The dynamic trigger range gets calculated at that point in time. It takes into a bunch of factors into account, and then calculates the dynamic trigger range. And we're looking for little 2-bar ranges that penetrate the dynamic trigger range to play off of on the 20-second chart. So here's an ES scalp example. You can see we had the 2 little 20-second bars. One was the red kind of, what do you call that? Well, it's like a little pivot low bar there that poked back. Then we penetrated back to the upside. So let's just say we took an entry around that 7250 area where we got the round, the circle. And then we made an impulse move up. And then you can see up there at 7450, that's a 2-point target. That's the recommended first high frequency target. So, but the other thing is, based on our rules of, 3 higher highs, I'm sorry, three higher lows above your entry, you'd already be at break even on that trade within, 3 bars of taking the entry, right? No lose. So that's a situation where, you've got a foothold in the market, there's no risk, and you just let it run to the first target. Okay, let's go to the next slide there, Bill.
Okay.
Now here's an example of a YM short. You can see how we had the 20-minute incremental, the time slot start, and then the dynamic trigger range was computed. We got a breakdown, and you see, again, we like to play off of 2 penetration bars, but then we also get patterns that form. So you can see we had the red bar that broke down, and then we had a green bar, and then we had another red bar, right? So you can see right away we're able to start drawing a little descending or bearish wedge, bearish flag, right? And then we break out of that. And so let's say that we were really, you know, trying to verify everything, right? So we're gonna wait till we even break those lows that broke out of the wedge, right? So taking our entry there at 960, the little circle, and then we got the move down. So right there, that's like a on the WAM, that's about a 40-cent move, I think, 45-cent move on the, I'm sorry, 45-point move on the YM. So that would have blasted right through, 10-point target, 20-point target, almost ran down, depending where you took it, almost ran down to a 50-point target. So what I'm trying to show you is that these are very doable, these numbers, right? They occur with great frequency if you're in here trading. Okay, let's go to the next example.
Okay.
All right, here's the NQ. And remember, the NQ was 3 points, 5 points, and 10 points. And so you can see this impulse move actually hit all three of those kinds of targets. As price, this was a little bit of a volatile breakout, but you can see as price got out and we start looking at little 2-bar ranges to play off of, narrow bar ranges. And so, and then we did get a pullback, kind of a ascending wedge, bullish flag there. So let's say that we even waited and took the entry way up there at like 34 instead of like right above the top of the range. We still ran up and hit those 3, 5, and 10-point targets with relative ease. Okay, now remember the setups work great in active markets. Almost nothing works in a dull market. So part of our job, and Bill and I did a great training on this, and there's a video on this about how to know when the market's too dull to want to try to trade it. You'll want to get in and watch that video. All right, now let's go to the next slide.
Okay.
Okay, so the next slide here, we're going to talk about my Power E-mini 2-3 scalping plan. All right, now some of you folks that are would-be scalpers or might not like this part of the training, but this is the way to go, and I'm going to explain why. One of our big, what's the word? One of our big sins and one of our big risks in becoming like a discretionary scalper is that we can easily fall into over trading, right? Because it's kind of fun, right? You're getting these quick moves and you're able to pick off a couple points here and a couple points there, and so it can lure us into the trap of over trading. And basically what happens is maybe you catch a couple winners and you go, wow, this is great, like stealing a candy from a baby, shooting fish in a barrel, and you just keep going. Market gets dull and you give it all back, right? Then you got to pay the commissions for your 20 trades you did. So this little methodology here will keep you on the right track. So let me explain what it is. If you're going to be a scalper, I recommend that you go for 2 wins, and that's it per session. Now you might say, what? Only 2 winners? Well, I want to be a scalper. I want to scalp all day and make tons of money. You don't make more money by taking more trades. You make more money by increasing your position size on something that works. So if you can get a 2-win day to be like a high frequency thing for you, then all you do is you gradually increase your position size. And that's how you're going to make more points, make more money. Okay, not by sticking around all day. The longer that you stick around, the higher the risk you to give it all back. Okay, trust me, been there many, 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 many times. So this plan takes advantage of like statistics. Okay, so let me explain it. What we're looking for is 2 wins. Now just imagine a mix of trades, whether they're winners, losers, break evens, whatever. But if you have 2 wins and you show a net gain, then you quit for the session. If you have 3 stops, whatever the mix is, it could be 3 stops in a row. But whatever the mix is, if you end up getting 3 stops, this is where there's a loss, and you have a net loss, you quit. Now, there's little variations in the middle, so I'm going to talk about that. So Here's some scenarios. You come in, you win 2 times in a row, boom, and that's relatively. I don't want to say it's easy, but that can be a high frequency event when there's an active market that's got some energy. There's no big deal about catching two winners, right off the bat in the morning. Then you're done, right? You take another trade to try to get that third one. You risk going right back down to where you only have one win, right? So uh, the recommendation is you go for 2 net wins. Now, let's say that you come in and right off the bat, maybe it's just a really crappy day, you get 3 losses in a row. You quit for the session. Let's say that you come in, you win on a trade, then you have a loss, then you win, right? So with that scenario, you should have a net gain, right? So let's say that even if your gain and loss were identical, so you win 10 points, you lose 10 points, you're back to 0, and then you win 10 points, you got 2 winners and a net gain, you quit for the session. Okay. Now, trust me. Uh, Again, the rule is you don't make more money by trading more. You make more money by increasing the size on what works. So this is something that you can definitely get to work because it's not a huge leap of faith to come in and be able to get 2 winners early on. And now let's do one thing, Bill. Can we go back to the slide that was the 20-second micro setup that showed the, yeah,
Sure.
it says 20-second micro setup.
Yep.
All right, let's go back to that. And the reason now that even your little two win scenario, 3 loss scenario, using the new 20-second micro charts where we're going to be protecting much tighter areas even skews the odds in our favor more, because when we're taking our losses, they should not be the full wide stop. And that can keep us in the game a little bit longer, or when we finally end for the day, the loss is smaller, right? If we have to quit with a loss. So let's say we had 3 stop outs in a row, but all of them were half the distance to the full wide stop. You can see, we quit, but the loss is less. You get it? So what we're trying to do is over this series, we're skewing the odds in our favor. We're letting some of the impulse moves run out, with the ES like 2 points, 4 points, maybe 8 points, but we're always going to cap it off really tight down there, max 2 points, and then most of the time maybe like a point on these little micro protection levels. Okay, so now we can run back down to the let's go to the time of day slide.
Okay.
All right, so the other thing we can do with scalping to help regiment our plan and also not overtrade is to regulate the hours that we trade within. Our first 3 hours are the active, most active, most liquid parts of the market. That's the first 2 hours of the session, as I've said before, is our European US overlap. That's where both markets are trading, so we have increased volume. And then at 8:30 East Coast time, the Europeans market shut down, and then so gradually the volume starts to drop off, and that's why you don't want to stick around too long after that. So the first 2 to 3 hours of the day session. Now oil is a little bit different. Oil starts about a half hour earlier, so instead of 9:30, you'd go 9 o'clock. And normally you don't want to stick around more than 2 hours with CL in the mornings. That is the recommended time slot to trade oil. Doesn't mean oil can't move in the middle of the night. Doesn't mean there can't be some news later in the day that could pop the market, the oil market. But if you're going to be a scalper and you want to come in at the most liquid time frame, it's going to be 9 to 11, okay, East Coast time. All right, with the other symbols, the final 1.5 hour, if you're going to stick around, and here's the thing, if you've done okay in the mornings, you've hit your targets, just be done for the day. Go enjoy life, do something else, come back the next day. Again, it's not how much you trade, it's about increasing size on something basic that just works. That's how you make more, not by trading more. This also helps keep your commissions way down. If you become an over trader, not only can you go into big losing streaks because you're pulling the trigger too much, like trigger happy, but then your commissions get racked up. I can remember way back when I thought I was so smart, and I did exactly one of these over trading days where maybe I started off with some gains, and then I quickly those got eroded. Then I went into the negative, and I thought, oh, I just got to get back to break even. So I was able to do that, Um, but then I had 40 trades of commissions to pay. Right, it was crazy. So this helps keep your commissions down as well. All right, let's go to that final slide.
Okay.
Well, it's not the final slide, but okay, so here's an example with the ES. Now, what I've been talking about so far, and I recommend that if you're relatively new, or even, it doesn't matter how much experience you have, if you're new to our style of trading, it behooves you to take the gradual, slow approach. There's no reason to rush and complicate stuff. Go in with single positions and single exits, right? Do that for a while and graduate later, after you show gains and progress, graduate later to more complex stuff. Okay, by then you should have uh, risk capital, house money, right, that you've built up. You can afford to take on some complication and maybe some extra risk. But here's an example where we can split our positions up. Now, so I recommend when you first start, it's one entry, one exit. Keep it simple. As you go, you can start breaking things up. So we call this, I call this the delta neutral setup. Okay, and so we have a delta target. So I mentioned that the high frequency targets for the ES are 2 points, 4 points, and then we go out to like 8 points. Okay, so on this example here, let's say you went in with, we're gonna do a 2 contract example where you split it in half. We go in with 2 contracts. The full stop would be down there at 2 points, but again, we may use on our 20-second micro bars, we might have a tighter stop out. But let's just say we're going to put a 2-point stop in. And what we're going to do is we're going to go for a high frequency delta target, which we take profits on half. So we would pull 1 contract off. Now, you could go for the 2 points if you want to bring it down to a point and a half, anywhere in there. And again, it depends. Sometimes, some days we have extremely dull markets where you could be sitting there for 15 minutes biting your fingernails, and the dang ES won't even give you like a 3-tick move in your favor, right? Other days it goes leaps and bounds, 3 and 4 points at a time. So there's maybe a little bit of discretionary decision making here, but again, we deal with approximations. So pick anywhere from between a point and a half to 2 points as your delta target, where you pull half off, and that allows you to tighten your stop a little bit. And lo and behold, you still have wiggle room, but you're at a virtual break even. So if the trailing stop got hit, you basically, there's no loss, or it's right around break even. Okay, and then so let's say we get our quick delta target, a point and a half, 2 points, whatever, and we can ratchet our stop up, get to virtual break even. Then you can stay in the trade for a bigger move without fear, right? That's the whole benefit of this concept is we have a high frequency that we can get the first target. Once we do that, we have no risk. We can let things develop. So you may want to go for a 4-point target then on the second contract. If it's a hot market, you might want to let it run towards the 8-point target. Okay, you have that decision. You have that ability to make that decision because you can't lose. And just because, let's say you say, okay, I feel like there's some energy in the markets. I see the markets moving, making higher highs above the opening 5-minute range, right? We're moving to the upside. I'm going to go ahead and let it run towards 8 points. And let's say that it gets past that 4-point target and goes to 5 points and 6 points, but it can't make it to the 8 points, right? Well, by then you can be trailing your stop up based on our trailing stop rules, and maybe you'll get taken out at the 4-point level anyway, right? So you gave it a shot to go to 8 points, but in the end, you didn't not make any money. You got the 4 points, right? So you've got a little bit of discretionary leeway to work once you get to break even. Okay. Now, you can extrapolate for each one of these symbols basically where you want to stick your delta targets. You can go back and look at that. I mean, we're going to post that uh, list, that slide. We'll post that slide, and then you can go back and you can calculate. So, for instance, with the CL, you might say, okay, I'm going to take a delta target of 10 cents, but then I'm going to have my macro target be out there at like 30 cents. Okay, that's in between the 20-second and or 20 uh, cent and 40-cent target, right? You have a little bit of discretion to do that. Okay, does that make sense? So don't get too wrapped up about this delta target right away. I would stick with, one entry, one exit to get going and get through. I mean, there'll be plenty to work with. You'll hit plenty of targets. You'll make points. All right. Save the fancy footwork for down the road when you've got risk capital to work with. All right, let's go to that final slide there, Bill.
Okay.
And just as a reminder, in our new version of the software, our tutorial button, it's up in the right-hand corner, goes to our new knowledge base page where we're going to be posting all the latest, newest stuff to get you right to, all the current uh, uh, methodologies and how the algos work and whatnot. So you're going to, for the micro trader, you're going to want to get in there and check out this section, Trading the New Power Micro Scalper. Besides today's training, go in and make sure that you cover these videos as well. The one down there, it says must see, that is a real good one that talks about the different setups that you'll play off the 20-second chart in combination with the new micro dynamic trigger range. All right, so you definitely want to watch that. But get in there and review these materials. Okay, so that's what we've got for you today. Short and sweet, but gives you plenty of information. Maybe go back, Bill, to the slide that shows the all the symbols with their targets.
Okay. Yeah, that's a good slide to.
Let's go ahead and leave that slide up, and then let's go ahead and see if take any questions that have come in.
There we go. Okay, let me get to the questions here. Let's see. Oh, somebody wanted to know about some screenshots for the NQ or the CL today. So let's see. Um, Someone else asking about the countdown clock there. Oh, one thing I wanted to mention was when you first open up the software in the morning, the alert software is going to basically start at 20 minutes until the timer on the back end actually reaches one of the one of the resets. You know what I mean? That's something that I noticed. Actually, I hadn't noticed it until this
Y-
week.
Yeah, let me explain that. Yeah. Um, that is that is potentially true. That is something that what I'm trying to do is see, here's the way it works is the system basically sends a little uh, little jolt to your alert software, and it just starts a timer on your computer clock, right? So, like you said, if you come in and you turn the software on, it's getting that initial jolt, and it just turns the timer on. So it's possible that when you turn the software on in the morning, that it might say 20 minutes, but then 8 minutes later it resets, right? And you get a new. So that's valid. So that's something I'm working on. Uh, I didn't want that to be a showstopper, just that little thing. So we programmed it the simple way, which was just to
Sure.
trigger your computer clock to be the timer.
It's no big
Um,
deal. It's no big deal. I just wanted to,
well,
make
yeah, right.
people
And I
aware
just want
that if they start the alert software at like 9:15, then at 9:20 it's actually going to go ahead and give the first pre-market alert.
Yeah. So but it's interesting to understand what the issue is. It's basically, uh, think about it this way: if the back end alert system had to, like, every second shoot through a signal to tell your clock to, you know, go down by a second, we're eating up like tremendous bandwidth going back and forth for everybody's software, right? So the way I designed it to just avoid that issue completely is just one little ping goes out, and that just like triggers to the thing to key off of your computer clock, right? And so we may have a workaround for that, we may not, but again, right, just be aware of that. Uh, the ideal thing is just start the software like 30 minutes before you're going to start trading.
All right, I got a question about using tighter tolerances. Is it possible to shoot for targets of like 3 ticks or a point? Because it seems like those would get hit more frequently. And if so, what would I use for the initial stop loss?
Well, you can't really get any tighter than the 20-second little setups that we've been reviewing. So don't think you're going to try to get any tighter than that. You're shooting yourself in the foot, though, if you're going to go for 3 ticks to, uh, I mean, in the past, with the really high leveraged regular size contracts, we had delta targets of 3 ticks, but then your secondary target might be, out 2 points or something. That was on the full sized ES contract, right? For a newbie back in the day before the micros. But with the new micros, uh, I would go ahead and
Go ahead.
all right, we had some noise disturbance here. What was I saying? So with the new micros, you know, uh, uh, again, 3 ticks. If you're going to go, uh, if it's the full position, like in and out, right? Entry, and then you're out at 3 ticks. It doesn't make any sense. You're not going to make any money that way. Your win ratio has to be so high that you won't be able to maintain it, and you're shooting yourself in the foot because the all these symbols commonly go out to these bigger targets, right? Now that we've got the refinements. So my strong advice here is open things up, go for the bigger targets. Uh, you know, again, now uh, if you want to use, like, let's say with the ES, go for a 3 tick target as your delta target, right? And you're going to let the other one, and that's just to get you to virtual break even, but then you'll let the other contract run 4 points or 8 points, whatever. That's okay. But if you're going to go one entry, one exit, and you're always going for 3 ticks, losing game. You won't make any money that way. Trust me.
One thing I've noticed about the behavior of the market kind of recently is that there's a lot of days where all the action kind of, today's a good example, the action occurs in the first part of the day, and then it starts getting really dull, and the market just basically trades sideways in a super narrow range. And I've found in the past that you just basically you have to sit that out. I mean, I know it's tough for some people because when you think, like you said earlier, when you think of being a scalper, you think of sitting there all day and trying to take all these trades. But when you see the market just kind of going sideways, and maybe that range is like a point or point and a half or something, there's no way. I mean, I can look at it and just tell that there's no way, unless all of a sudden there's some major breaking news, which is extremely unlikely. It happens, but it's unlikely that you're going to get a 4 point move, right? In the middle of the day when the market's just sitting there going sideways. And so the only thing that you can do is basically just avoid trading that. And see, that's where the discretion comes in. So I get a lot of people that ask about, trading every single alert. I mean, there's like 20 different ranges, I believe, that are going to get generated during a session. But that doesn't mean that you want to even attempt to try and trade all of those. You don't.
Yeah, and we talked about in the one training how to avoid a dull market. Uh, a hot market moves off the opening price level. It moves outside the first 5 minute range, and it either makes higher highs or lower lows away from that initial 5 minute range on high volume throughout the session. That is a hot trending day. You almost can't miss it, right?
Yeah, but they're
On
not
the
that frequent.
Well, right,
That's
but
the
on the flip side, dull markets, just like you said, we can get action in the first couple hours and then the market just peters out. So that's why it really behooves you to just uh, you know create a regimen and focus on the first couple hours of the session. Use that little plan with the two net gains. And again, get away from thinking that you have to trade more to make more. You increase size on stuff that works. That's how you increase your profits. Almost nothing works in a dull market. It doesn't matter what newfangled setup somebody can try to sell you. It just won't work in a dull market. It's kind of like trying to fish where there's no fish, surf where there's no waves. It's real basic like that. Try skiing when there's no snow, right? So it's a real basic concept. So focus on the first couple hours. Stick to the rules. With your gains and your losses, your max drawdown limits, and you can make this work, right?
I think that the YM is kind of the YM's $5 a point, right? And the Dow tends to move, since it's up here at 27,000. I mean, it tends to move, 100, 200, like right now it's up 230, right? So it tends to really move. And the cool thing about the YM is it's kind of like a happy medium between the micros and the full size contracts, right? And so, I mean, at $5 a point, 20 point stop there, you're talking $100 of one contract. But if you catch a move and you can let it run, 50, 100, 150 points on a trending day, then it gives you a really good risk reward, is what I'm thinking, right? Because, two contracts, 1 point or 2 point stop on two contracts on the ES is $200, but on the YM, one contract, if you can get it in there, like you say, plant a seed and let it run on a trending day, you can really score some good points.
Well, sure. I mean, YM is a. Here's the thing. All these symbols, uh, they behave a little differently. They each have their pros and cons, but they they all have the high frequency targets, and they all can be playable. So it's hard to say like, well, this one's better than the other one. Um, I would almost say, the one that you're interested in trading, trade that symbol. Starting off with the full size CL is probably not recommended. That's $10 a penny. So, that's probably a symbol reserved for later when you're very experienced and you have proper account size and risk capital to deal with it, right? But but yeah, a real good one to start with, like you said, the YM. It also simple because you're just dealing with points. You don't have quarter points and all that. A YM, the YM micro, that's the basic one, the easy one to get started with. Uh, but I'll give you an example, like the NQ and the YM, we can look at them and see that they can, make bigger moves, let's say, than the ES, but they can also be a lot more volatile than the ES. So it's we're kind of just trading uh, little things around a little bit. Best thing to do is decide which one you want to trade with the regular size contract, and then just pick the micro for it for the ES, the NQ, or the YM, and uh, and go for it. And these are the high frequency targets that work off the micro. Uh, if you sit and do the math, you'll see that most of these targets, they kind of equate around the same, dollar amount. For the targets. Anyway, go ahead with the next if there's
Oh,
another
well, I
question.
was I was just going to comment that in the past, recently, since we started this new the new micro trader, it seems to me like the best trades that I've had, and I have an ATM set up with the delta target and all that, and getting to break even, and so that's kind of, that's something that I actually really believe in, because it's relatively easy to get, three ticks or a point delta target, and now you're at break even. And I've found that letting the other contract run and basically managing the stop myself, based on, like, what we've done talked about in the past, like previous two bars, or and your little three bar trick there. Once you get three higher lows in the case of a long, then you move your stop up to your actual entry. But I've found that the best trades come from sort of slowly and methodically raising the stop, ratcheting your stop up, and just sticking with it as long as the momentum continues, because every now and then you do that and you get one of those, you get a run up in your favor, and maybe you are up, 4, 6, 8 points or whatever, and then you get one of those big, like a long range bar, right? And so, just in the past, from my experience, I found that, basically, like, getting taken out by the stop is almost better than selling, than having a specific target and taking it all off at the target.
Well, sure. Again, it's going to depend on the market energy. We could have like 3 sessions in a row that are super dull, and the ES might hit a 2 point target like every entry, but it never gets past that, right? So if you're hanging on for more, you might keep getting knocked out, break even. Then on the other hand, we might have a day or two rip roaring hot markets where, if you took everything off at 2 or 4 points, you could have gave up a lot, right? So you again, this is where a little bit of the discretionary stuff comes in. A lot of that can be gut feel. I mean, I can tell when the markets are hot and when they're not, right? It's relatively simple. High volume, we're getting nice waves in the market, and we're moving off one way or the other off that 5 minute opening range, forcefully. That's a hot market. So it behooves you then to open things up on a day like that. If we're halfway through the session, which you shouldn't be trading that late anyway, but uh, and we're still hemming and hawing around the 5 minute range, right? Opening range, you got a dull market. So don't ask for much. Get your 2 wins at 2 points and that call it a day at that day. So uh, again, this is why we call it playing the market, because there is a little bit of you know luck of the draw built in, but we're using as much technology as we can muster, and we're refining things down as much as possible. But in the end, we're still, as discretionary traders, we're still getting in there and kind of playing the market using our various methodologies. So,
Yeah, I got to say that the ranges are pretty. The ranges are pretty amazing, and I'll tell you why. I even noticed this morning, is that one of the ranges I noticed had a really nice breakout to the upside, and it got some pretty good traction. And then, it started, the price kind of fell back, and started drifting down. And maybe like 5 minutes later, it came down and like literally retraced right to the tick to the top of the range, and then that's where it bounced again. And I was looking at it and I was thinking to myself, well, geez, this range got established, 10 minutes ago. But it's just amazing after watching the price behavior at the ranges for so many different resets of it, how accurate they can be. And the idea, back to basics, is that we're looking for a breakout of the range that can get some traction and move fairly significantly away from and out of the range, right? And so
Yeah. Yeah, the uh, for any of you new folks, the dynamic trigger range concept goes back now like 5 years is when we came up with it, and we have refined it more and more and more. And so uh, not only is this version of the dynamic trigger range, there's some new enhancements that I built into it, but the calibrations are much more finely tuned. On top of that, it's hooked up to the new time slot concept where we focus in on the hot periods of market activity, right, with our 20-minute timer. So uh, all that in combination, yeah, that's why we're getting much finer moves off of these tightened dynamic trigger ranges in our favor. So the goal was to really take the mystery out of trading, so that you're not sitting around all day wondering like, well, I wonder when another alert's coming, right? It could be 10 minutes or it could be 2 hours, right? So we get away from that because we have our 20-minute time slots now, and we're playing off the 20-second chart. So again, you're not sitting there trying to like decide if you're going to take an entry off of 4 or 5 minute bars, right? We're playing little 2 and 3 bar 20 seconds. So we're dealing right down there within, a minute or so, and we're able to catch entries that move in our favor quickly, move away from our stop quickly, and we can protect relatively tightly. So we're getting much bigger bang for our buck. So I think this is a big win-win for everybody, and it really, I enjoy trading off these new micro ranges a lot. I mean, this is, I invent all this stuff for myself to use, and then basically we share it out through the alert software. So
yeah, I
uh,
think this has been a really big enhancement. So, well, that's all the questions that we have for today. So let's go ahead and wrap it up so everybody can go about their business and get some lunch. And hey, thanks for bringing this presentation to us. And we will
no
go ahead
problem.
and post a replay of the video and the slides for everybody to review. So have a good weekend. And thanks, Jeffrey.
All right, we'll see you, Bill.